Johan, we saw that figure coming in much lower than anticipated. The market was expecting 5.9% and we saw it at 5.7%. Is it going to go lower soon, or are we turning now?
Yeah, look, it's indeed a pleasant surprise. Looking back, the peak was probably in January at 6.3%. And we've been anticipating a gradual moderation in the rate of inflation, but admittedly, this number for May at 5.7 was even better than our expectation. And analyzing the numbers and looking forward, it does indeed look like we set to see further moderation, to the extent that by the end of this year, we might be back at sort of middle of the target band levels, around about 4.5% in our forecast.
What's that going to mean for consumer spending, and especially for our retailers? We know the PEs are up in the sky. Do you think that earnings are actually going to come through and support those PEs?
Well, look, as far as the retailers are concerned, to the extent that they do not increase their prices, obviously their nominal earnings performance won't necessarily increase. But I suppose what it means for consumers is basically that the erosion impact of higher price increases will be a little bit less than we thought before. And that might culminate in a slightly higher rate of increase in real demand. But like I said, from a consumer expenditure or from a retailer perspective, the nominal number should remain more or less unchanged. So they don't necessarily, or they won't necessarily see much of an improvement there.
Johan, I know these numbers need to stay low for a long time, or stay high, or whatever is required. I mean, oil prices down to 95, so that means less imported inflation if it were to stay down. We've got the rand down to 820, so that also looks good for inflation. And obviously that has to stay coming through. But administered prices, we haven't talked about them for a while, but Eskom, more price increases are coming on down the line, and whether you put them in the basket or out, they're going to impact on the consumer. And we've got whether they pay for tolls through levies or taxes or whatever. So there are other costs to come here which could push inflation on the upside.
Yes, indeed. Look, administered prices still running at a rate of 11.4% year on year, which obviously is still well above the upper limit of the target band. And in terms of the forecast I gave you earlier, we've assumed that we're not going to get any unpleasant surprises as far as tariff increases for electricity, etc. are concerned. So clearly that is an area of risk. The oil price, yeah, that's very good news. You know, the dollar price of oil plummeted in excess of $30 a barrel now from the recent peak. And in terms of research done by the Reserve Bank, should that be sustained for a full 24 months period, all other things the same, for every $10 a barrel, it could shave 0.6 of a percentage point off the eventual inflation rate 24 months down the line. So clearly that's excellent news for us. To the extent that the rand sort of weakened, that obviously counteracted to some extent that windfall. But yeah, on the assumption that the rand sort of will remain around about prevailing levels, it's certainly looking good from an inflation perspective.
Of course, people weren't talking at all about a cut for months, and indeed for years. Then they were talking about increases at the end of this year, rate increases at the end of next year. Now the talk is of a possible cut. Now, given what's happened in Europe, what's the likelihood of that?
Yeah, look, just as far as the market's view is concerned, you can simply look at the 12 by 15 FRA or the forward rates, and you'll see how confused the markets really were up to now and probably still are regarding the prospects for inflation and interest rates here. You know, at some extent, the market's priced in a significant increase in rates by now. And, you know, it swung around to a cut expected and then back to a hike expected. And now we're sort of back in the cut territory. Obviously, one of the major risks as far as South Africa is concerned is the European story, to the extent that it might culminate in the risk of sort of trade, which could push our currency quite a bit weaker, and then obviously that should eventually culminate in higher inflation. The other significant risk for us, I believe, is the current account. And as we speak here already, we've seen significant deterioration in the current account. And that is our old Achilles heel. You know, more often than not in previous cycles resulted in the need for an early termination of the upswing
Johan,
by tightening
is
monetary
that a
policy.
cut or is that no cut in your view?
Well, in the short run, I'd say there is a possibility of a cut. I'd give it a 50-50, depending on which angle the bank takes, but I'm afraid 12 months down the line, at the rate of deterioration in the current account, we in all probability will start seeing the red lights flashing, which might culminate in a hike. So for now, you know, 50-50 between a cut and unchanged, but you know, the current account certainly is a factor to be watched going forward.